Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So the S&P 500 has 11 different sectors, and in the 2024 and 2023 there are some companies that have done absolutely amazing, some sectors that have done absolutely amazing, and others haven't done well. What I'm going to do today is focus on one sector that has not performed well at all in 2024, and that sector is REITs, or real estate investment trust. Real estate investment trusts is quite interesting sector because instead of owning, some people invest in them because for the income reasons. So they do pay a lot of passive income, and one of the things I like about it, the fact is, it's the fact that you're not really investing yourself in the property world. There's some professional management company that's actually managing your property for you. You don't, of course, own the actual property. You just own equity within shares within these companies, but they do all the management side of things, and it's very liquid. What I mean by that is, you don't, when you want to sell a house, it takes ages, as you know, solicitors and all sorts of things. But you can buy a share right now and sell it in next minute, and that is one of the reasons why some people invest in real estate, basically in REITs, because you can get a yield of at least 4%, 5%, 6%. Again, if you're not chasing yield, you can even find some really good companies that have not got a huge yield, but at the same time growing that dividend. And the fact that it's very liquid, you don't have to do any of the hard work, you don't have to be a landlord, is quite attractive. And right now, the basically REITs have not done well at all in 2024 because interest rates were very high. And when interest rates are very high, these companies or REITs do not do well because of the interest rates, the cost of borrowing is actually very expensive, right? So for that reason, they don't actually tend to do well at all. So what I'm going to do now is share with you guys 5 companies that are Sharia compliant right now, REITs, and at the end of the video, I'm going to actually add one of those companies in my portfolio that I have been doing quite a bit of research. I used to own it in the family portfolio, sold it and got it basically back again, and I'll explain all of that in a second. But before we do all of that, I would genuinely appreciate if you can like the video first, subscribe to the channel, let me know if you have any questions or comments. If you own any REITs, let me know what you own and so on. And if you can join us in the Patreon account, it makes an absolutely huge difference. So that will be absolutely wonderful thing to basically, if you can do that for us. And of course, join us in the Discord, where you've got a lot of brothers who are sharing very good practices. Right, so I'm going to share with you, like I said, the 5 different companies. The things that we're looking for are slightly different to when we are analyzing other types of stocks. REITs work slightly different. So you've got, for example, things funds from operations, which is FFO. So price to funds from operations is basically equivalent of basically PE. Then you've got the dividend yield, adjusted FFO, so adjusted price funds from operations payout ratio. That's the payout ratio for REITs, for example, and it's the equivalent of like sort of a free cash flow here. And normally what we're looking for is less than 90%, because these companies can basically can pay up to 90% of their dividends, basically of their free cash flow as a dividends. And then we're looking for the 5-year growth rate. We're looking for dividend streak, so how long they've been increasing that dividend. We're looking for the annual payout in dollars. We're looking for the dividend safety, and we're looking for funds from operation estimate for next year, so equivalent of EPS. Okay, equivalent of EPS, and then the revenue for the next year, a Morningstar valuation, and the fair value for these companies right now, whether they're expensive, cheap, and so on. And like I said, we will be doing some buys so at the end of the video, so don't leave. Okay, right, so the first company we're looking at is Mid-America Apartments Communities. This is one of the REITs that basically has properties that are owned, properties that are rented by professionals, so communities. So they build these apartment communities, and right now they are in some of the best basically states in the United States. So a lot of people are leaving, for example, big companies are leaving LA to move into, for example, Texas and so on. And this company basically is building a lot of properties for professionals, and I'll share with you guys some information about that in a second. So currently they have 17.6 billion when it comes to market cap. Price right now is $151 per share. Price to FFO of 19. we'll use this to compare with the rest, okay, with especially with the rest of the REITs. I think the rest of the REITs are around similar in terms of their equivalent of PE. Dividend yield is just slightly over 4%, which is really good. An adjusted FFO payout ratio of 77%, so it's slightly lower than 90% that we normally expect. The 5-year growth rate of 9%, which is really good. Dividend streak of 13 years. So for 13 years, this company has increased that dividend on the last 5 years about 9%, which is really nice. You get $6.06, dividend safety of 97%, so very, very safe. And they're expecting the earnings, for example, or funds from operations for next year to grow about 1%. So this is not huge, but at least it's some growth, right? Revenue expected to grow about 2%, fairly value right now, $156 per share. So that's the first one. The next one that we're looking at today is this one here. This one is, by the way, you will see here the multifamily residential REITs, and this one is a data center REIT at Queenix. Okay, this is one of the companies that have been on my watch list for a very long time. Slightly expensive right now. Data center. So since data centers gone up, it's gone up a little bit. 86 billion market cap. So it's way bigger than basically some of the REITs that we're going to see today. Almost basically $900 per share right now, and then price to FFO of 24. So it seems a little bit expensive in comparison to the sector. Medium dividend yield of 1.9, so not huge for a REIT, and the adjusted FFO payout ratio of only 49%. So they have a massive room to basically grow that dividend if they need to. The 5-year growth rate, we're looking at about 10%. Dividend streak of 8 basically years of increasing that dividend. $17.04 is what you get for every share of this company that you own. Dividend safety 86%, which is very safe. And then FFO next year is basically expecting the earnings or price to free funds from operations to grow at least about 11%, which is, remember, this is just the estimate as well, remember that. And then basic revenue, they're expecting about 8%. Now 11%, like I said again, when it comes to the basic how expensive it is right now, and $810 per share is where they think the price should be right now. As you can see, the market is open, so it's about $900 per share. I'm going to show you a couple of things. When we look at the mid-America apartment communities, you can see for the 1 year it's actually up about basically 12%, so it's actually done decent. It wasn't basically bad at all for base 2020 in comparison to the rest of the sector. If I quickly show you here, okay, so this is the S&P 500 per sector, basically sectors and what they've done over the last basically 10 years or so. Okay, now as you can see here in 2024 is basically this column here that we're looking at. As you can see, the best performing was basically telecommunications. That includes companies like Google, for example, companies like Meta and so on, or Facebook, whatever you want to call it. Tech was the next one, so information technology was 36%. Financials was 30%. Consumer discretionary, we're looking at about 30%. S&P 500 was about 25%. Utilities about 23%. Industrial 17%. Consumer discretionary, we're looking at consumer discretionary, we're looking at about 14%. Again, we look at stable, sorry, not discretionary, that's the discretionary 30%. Consumer defensive or consumer stables, we're looking at 15%. Energy about 5%. Real estate about 5%. So you can see these sectors are the ones that have not done well. I thought healthcare has done slightly better, but they actually haven't. So it'll be interesting to see. So in the next few weeks, what I'm going to try to do is find some value in these companies, because real estate, because of the interest rates coming down, real estate could potentially be doing really well. So that's why we're looking at it now. We will be looking at some energy companies because potentially, Donald Trump coming back, he loves drilling oil. So potentially we will see if that helps the overall market. Healthcare is an interesting one because of a lot of the elections and things that have been happening. It has come down quite a bit. It will be interesting to see what happens because of what happened to United Health and their situation with their CEO being shot or whatever. That has basically shocked the card market. So we'll see what happens with that. And then materials, I'm going to look at it. Materials were completely flat for that year. So we will be looking at that at some point. So the next, you can see this is basically, this one was up about 11-12%, which is actually better than the sector, if you like. And as you can see, the other one is also up 10%, which is really good. They both done better than their sectors, if you like. Okay. So the next one that we're looking is the equity lifestyle properties. Again, and basically this is a housing REIT, $12.4 billion of market cap. Price right now $65 per share. Price to FFO, we're looking about 25 right now. Dividend yield of almost 3%. The FFO payout ratio, we're looking about 77%, which is very similar to this one, but the 5-year growth rate is about 10%, slightly higher than this one. 19% basically years of increase in that dividend, which is the highest that we've seen so far. $1.91 basically is what you get. Dividend safety of 86%, again very high, which is nice. They're expecting the funds from operations to grow about 5%, so better growth in terms of ones that we've basically in comparison to this one here. And revenue estimate for next year is about 5%, so 14% discounted right now. $76 per share is where they think the price should be. This one hasn't done much for this year, so it's up almost 7% down. So we'll see if basically they do better in 2025. The next one is CubeSmart. This is a self-storage REIT. I used to own one self-storage use. If you remember, that was public storage, and then it became basically non-Sharia compliant because they were dealing with some sort of riba basically, and they were charging people all sorts of things. So I've kind of sold it. Because the business side of it was more than 5%, so I've sold that. $9 billion in terms of market cap right now. Just about $41 per share. Price to FFO, we're looking about 15. So the cheapest that basically based on this right now. Dividend yield over 5%, so the highest that we've seen so far. 77% when it comes to payout ratio, and the 5-year growth rate 10%. Dividend streak of 14 years, $2.08 is what you get. Safety 61%. FFO estimate for next year is about 2%. Revenue is about 3%. 12% discounted right now. $48 per share is where they think the price should be. And as you can see here, this stock's down actually about 10%. Now the final one is Camden Property Trust. This is a multifamily residential, very similar to this one, and it's almost $12 billion in terms of market cap. $112 per share right now. FFO or price to FFO is about 19. Dividend yield of 3.6%. Payout ratio 70%, so it's slightly lower. The 5-year growth rate we're looking about that dividend, we're looking about 5%. 2 years of increase in that dividend. Annually you get $4.12. In terms of dividend safety, 80%. FFO estimate for next year, we're looking about basically 0.5%, and revenue is about 2%. Fairly value right now, $117 per share is where they think the price should be. And in terms of last year, this company has actually done well, about 13% up basically in the last year. Now what I'm going to do is I'm going to show you all 5 companies. Okay, we've got all of them here. So, and then you've got the S&P 500, which I will show you in a second. But if you look at the last 3 years, they basically not all basically great in terms of basically appreciation. This is basically, by the way, total return. That includes dividends and price appreciation. 27% basically, this one here. The rest of them are actually negative. When you look at the 5 years, this one is about 33%, 13%, 66%, 3%, 61%. So this one is done again. Cube is done actually amazing. And then you've got this one here is about 23%, while the S&P 500 is done about 92%. So none of them actually beat the S&P 500, but these are income play. Remember that people are not buying this just to beat the S&P 500. You're buying it for that income predictability, the fact that they're going to increase that dividend, and you're going to get that solid dividend every single year, year after year, and then that's basically, and you just leave it alone, sleep well at night sort of a thing. So 158 for the last 10 years, which is really good in comparison to the S&P 500, which is about 240. Let's call it 240. So not bad at all. 70%. This one is done really well. This is more or less a tech company, because everything they own is a data centers. They own all the data centers. They set it up, and other companies rent from them and use them, whatever, right? This one, 191%, so that's really good. 138%. I thought they'd done better than that, but they haven't. And basically, this one is done 106, basically, in comparison to S&P 500, which is about 200. Let's call it 240. So overall, these companies have done all of them well. And for me, the one I'm actually planning to add to the portfolio is this one here. I had it before, and there's a reason why I'm doing this, because if we go back here, It's a multifamily residential REIT. And when I looked at basically their latest earnings, I'm not going to go into it, all of it. If you want me to do a whole video, I'll do it. But one of the things I liked about the company is they basically, one of the things that they talked about, let's see if I can find it now, is basically this. So a lot of headquarters, companies are moving their headquarters from, for example, Palo Alto in California to Houston, Texas, for example. So Oracle is moving, and Caterpillar is moving, for example, Chevron is moving, HPE is moving, Bowen, Raytheon. All of these companies are moving to different basically states where this company is operating, and this company has realized basically they need those professional people that work for these companies, and they are actually building those constructions these companies need. So if you look at here, you can see Samsung, for example, Taiwan Semi, basically Texas Instrument, and Intel and Oracles and so on. And one of the other things that I was looking at early, if you want, like I said, I'll do a whole video if you want me to at some point. But one of the things that I found it fascinating is the fact that a lot of their people that live in their companies, for example, actually are basically working in terms of healthcare. It was like about 14% of the people that live there from healthcare, technology 9%, financials, education, retail, and so on. So they are professional people that live in those properties. So what I'm going to do now is basically add that company to the portfolio. And the reason, like I said to you guys, is I really like basically the REITs. This is a bit of a risk, by the way, and the reason I say that is because REITs can easily change the Sharia compliance side of things. So I'm gonna add little bit. Okay, like we've seen already, this is sort of a fairly valued at the moment. So 156 basically where they think is 151 right now. So I will be buying here and there, and of course if REITs start just basically make a comeback, and hopefully overall it will be good. At the same time, I'm happy to collect that dividend. Remember, my portfolio is basically income based in the long run, but I want to build those positions now rather than doing it 10 years from now on. So I want to have that growth and income at the same time. Looking at the portfolio right now, there's a more of a growth side of things than actually income, having got rid of companies like J&J, Medtronics, and so on. That has reduced the dividend pay I was getting before. So inshallah, I will be putting more emphasis coming weeks, inshallah, or months, for the base of the income side of it, and invest in companies like in the oil side of things, companies that are quite basically down a lot, like UPS and so on. So I'm gonna buy £300 worth of this company, and like I said to you guys, I will be inshallah doing it, whole video if you want me to later on. But there you go, that's the company I wanted to add today. And like I've always said to you guys, I'm trying to be as transparent as I possibly can. There we go, we've got 2.4 shares and average price of $151 per share, or $124 per share. Inshallah, I will be adding if I add more, I will let you know in the community. If you're enjoying this type of content and you like what we're trying to do, join us in the Patreon account. And like I've always said to you guys, please don't buy these companies because you've seen me buy it. Do your own research. There's a reason why I have a plan, and my plan, inshallah, like I've always said to you guys, is to be able to live off of my basically investment, whether it's properties or stock market. And one of the ways that I want to do this is because it basically is owning this type of business, because when you're looking at a company like this that's giving you 4% safe dividend, basic market cap, which is actually huge, basic payout ratio quite low, latest increases actually being nice, and so on, increasing that dividend year after year. And then top of all of that, basically is not too expensive right now. And then when you look at things like the payout ratio, is actually kind of stable. For example, the payout for free cash flow, we don't even look at that one. Adjusted FFO per share is actually growing. In terms of revenue side of it, is actually growing every single year. They dilute their shares, of course, these companies, that's quite common. And return on equity is actually 9%, return on invested capital of 6%. So operating margins, free cash flow, all of these things are absolutely amazing when it comes to this business. So inshallah, I'm going to hold on to this one for a while. I'll let you know what happens moving forward, inshallah. Have a wonderful day. Assalamu Alaikum.